Welcome to AllGen's Market Update. My name is Jason Martin. Today is June 4th, 2020, and wanted to bring you guys up to speed on what's going on in the market. So the market has really bounced quite a bit recently, so I'm going to talk about how the market's bounced and as the economies around the world start to reopen, along with COVID-19 deaths starting to decrease. So I'm going to show you that. I'm also going to look at an unprecedented amount of money creation or printing of money that the central banks around the world are doing, and just the amount of total worldwide stimulus. And finally, we're going to cover some the potential of bond prices maybe have peaking in the short term. So let's hop right in. So, a lot of people are asking, how can the stock market keep going up when the economy seems so bad? And there's a lot of reasons to that. I think the big one, one of the big ones is the stock market, as I've mentioned in prior videos, looks into the future. Okay, so the stock market's not as concerned with past news, things that happened in the past, but they're looking more so as what's going to happen in the future. And the stock market a lot of times is a predictor of the future. So the stock market is predicting, or has been predicting as it's been going up, the economy is starting to improve. One reason for that is that the coronavirus, and we're looking at a chart right here of the daily confirmed COVID-19 deaths. This is worldwide, and you can see kind of peaking in kind of early mid-April and has slowly decreased over the last month, 2 months or so. And really, if you looked at like the Europe and the United States, the numbers look actually much better than they look from a worldwide basis. You have countries like Brazil and like India and Russia and even Mexico right now that are starting to ramp up, whereas like the United States and some of the Asian countries and Europe has really gone, the cases have gone down quite a bit. So I think that part of the reason the market's been going up is the anticipation of economies reopening as governments and people become a little bit more confident to go back to work. So that's one component of it. And I want to look first, before I touch on the money creation side of things, I want to kind of just quickly review what the markets have done recently, because it's pretty impressive, both directions. We're looking at the S&P 500 here over the last 1 year. You see it dropped, its peak was in February 20th, and then the bottom, the trough, was on March 23rd. There was almost a 34% drop, that's in a time period of literally 1 month, which is pretty incredible. But at the same time, in about 2.5 months, you've had a rally of 40%. That's in the S&P 500, so that's U.S. large caps. The S&P 600 would represent U.S. small caps, even more dramatic both ways, as the stock market the small caps dropped 41% from their high to their low, and it's rallied 42% off of its bottom. And so, if you recall in some past videos, we mentioned that one of the things that we were doing, obviously trying to protect the account as the market was going down by holding long-term treasuries, long-term bonds that were going up as a safe haven play, and holding gold. Well, when the market was going down and those assets were going up, we sold some of the long-term treasuries, and we focused on the areas that got hit the hardest. And one of those was small caps. So a lot of when we did our rebalancing was buying into small caps as they went down 40+%. So now another area that is starting to show a little bit of leadership, or even come back a little bit more, is international and emerging markets. So this is the MSCI All World market, which is basically like the S&P 500, if you will, for international and emerging markets. And it's down about 35%, or it was down 35% from its high to its low, but it's rallied nearly 40% from its bottom. So that's also an area that we've used as the market dropped to diversify a little bit into, increase a little bit into international, as we've been holding a higher amount of U.S. stocks over the last 3 to 5 years, which has worked well because international has really underperformed, but it has started to outperform a little bit in the short term. We'll see if that continues. So one big reason, I think this is actually the biggest reason that the market is able to go up and make this rebound that it's making, is not only that it's anticipating, the market's anticipating economies reopening and people going back to work and unemployment improving, but I think the bigger reason is the amount of stimulus. And so what we're looking at here is the Federal Reserve's balance sheet. And so this is a chart I show quite often, but the Federal Reserve will do what's called monetary policy, where it's a type of monetary policy called quantitative easing. Quantitative easing is also known as money printing, but essentially what the Federal Reserve does is they create money in the trillions of dollars, and then they buy bonds. Usually in the United States, they buy treasury bonds and mortgage-backed bonds, all in an effort to stimulate the economy. And it stimulates the economy by making it easier for banks to lend, also bringing rates down so that it's more attractive to borrow and you're borrowing at a lower rate. And all that has the effect of stimulating the economy. Well, as you see, after the financial crisis here in 2009, the level of quantitative easing we did 3 rounds of those from 2009 all the way through 2014, totaled about $3.5 trillion. But if you fast forward to what's been going on over the last 6 months, we've done almost that same exact amount of stimulus, about $3 trillion worth of stimulus in a matter of just a few months. So if you think about all the stimulus that was created after the financial crisis, we've repeated that in a matter of 3 months. And we're not the only country around the world that's doing this. The European Central Bank is doing it, Japanese Central Bank, the Bank of England, the major central banks around the world are creating money and stimulating the economy. This is only on the monetary policy side of things. There's also other types of stimulus, like a lot of people have heard of the PPP program and the CARES Act and all of those. If you total them all up, and it's really the number that continues to increase day by day as new stimulus packages come out. But you're looking combined between the two, and I haven't found an exact number, but it's somewhere between 10 and 15 trillion globally. So it's an unbelievable amount of stimulus that is coming out. And there's an old adage on Wall Street that says, don't fight the Fed. Okay, and what that means is that, and when they say Fed, they're talking about the Federal Reserve Bank, and it's on both ways. So the Federal Reserve has the power to stimulate the economy, which they do by lowering interest rates, which they've done. They're down to zero, and printing money. And so the Federal Reserve also has the power to slow down the economy by raising interest rates or doing quantitative tightening. And so when the old adage says don't fight the Fed, that means don't go against what the Federal Reserve is doing. And right now the Federal Reserve and central banks around the world are stimulating like crazy. And so if you were to go with them, you're going to be on the long side or in favor of the market continuing to go higher. So something to keep in mind. Now, this is a really, really busy slide, and it probably is going to confuse the crap out of a lot of people, but it's just such an interesting one because, while the Federal Reserve and while central banks around the world can stimulate, and this orange line is the same line we were looking at on the previous slide of the money creation or the printing of money. However, I've thrown in 2 other lines. I've thrown the blue one here is gold, and then you have the 10-year Treasury rate, or the yield of the 10-year Treasury bond. And so there's 2 ways that really kind of creates inflation. And this is one of my concerns with the amount of stimulus that's been happening. And inflation can come in 2 forms. One inflation that most people know about is prices going up. So prices of things that you buy, whether it be gas or food or all the different types of things that you buy. That's price inflation. I don't see so much of that right now. My main concern is more currency devaluation, which is also a form of inflation. And there's 2 ways to weaken your currency. One is to print or create money, which again is the orange line. As you do more of that, that has a tendency to to cause more money, or to have more money, print more money, dilutes your currency, which can cause your currency to get weaker. And the other way is to lower interest rates. Both of those things can cause inflation and can weaken your currency. And so a good inflation hedge over time is gold. So the blue line again is gold. And the way this works, as interest rates come down and as we print more money, then gold tends to go higher. And then the opposite can happen as we stop printing money, and as interest rates kind of flatten out, gold can go lower. But you can see over the last 6 months what has happened. We've dropped interest rates a ton, we've printed a ton of money, and gold has gone up. And so gold is approaching nearly an all-time high, not quite there yet, but we've also reached an all-time high in money creation and an all-time low in interest rates. So this is something that we've held onto this over the last year, which is gold, and we're considering increasing it on a pullback. You never want to buy when something's going straight up, but if you get a good pullback, we may increase our gold holdings. I think it's going to serve to both protect the accounts, but also help grow the accounts over time. So in summary, the rebalancing that we have done as the market took a big hit, we had long-term bonds, and those long-term bonds went up a lot as yields have gone to an all-time low. So we sold out of that, and we used that money to buy the stocks that have gotten hit the hardest, some of the cyclical stocks, some of the small cap names, some of the international funds that we own. We've increased that. So that rebalancing has worked really well, both to protect the account, holding those safe haven assets as the market was going down, but then selling those as they went up a lot to buy assets that went down has helped us as the markets bounced as well. So right now, we are cautiously optimistic with the economy starting to return back to normal, the new normal, if you will. But also, because there's so much stimulus right now, that really acts as a tailwind to the stock market. But I will say that the risks are a little bit higher now. Anytime the stock market rallies so much in such a short period of time, you have the tendency to pull back or to consolidate. So risks are a little bit higher right now, and we're still, and when I say cautiously optimistic, we're that way in our portfolios. So we're not overly aggressive in any way in our portfolios. In fact, historically, we're still positioned more defensive than the benchmarks that we're going up against for each one of our clients' risk profiles. And then as we think yields have reached nearly an all-time low, well, they have reached an all-time low, and there's not much room for them to go lower. It's always possible they can go negative. They have in Europe and in Japan, but it's never happened in the United States. So the likelihood that we've potentially reached at least a short-term peak in bonds is pretty high. And that means there's a little bit more risk for your longer-term bonds. So we've been shifting out of our longer-term bonds into stocks, but also by doing that, we've also shortened the duration or gone shorter-term bonds of our overall portfolio. And then, we continue to like gold as both a non-correlated asset, as a hedge and a protection in the account, especially with the current environment that we're in being inflationary or a devaluation of our currency. So I hope this helps. We always want to keep you guys informed, and we wish you the best and the best of health. If you haven't done so already, click here to subscribe. We frequently upload market update videos on the coronavirus, provide financial planning tips, and relevant personal finance topics on our channel.